Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about exchange funds.
Not exchange traded funds, but exchange funds.
Yeah, so this conversation is coming up more and more with our clients. We wanted to go over what that is for people that have high concentration with individual stock and are looking to diversify their portfolio. But before we dive in, Mr. Collins, I just heard the crack of the beer.
Yeah.
What are you drinking?
It's a little bit messy. Apparently, someone shook this up without me realizing it. This is Deception Pass. It's a summer ale from Two Beers. It being in the middle of winter, me wearing a toque, I'm thinking of summer. So it clocks in at 5.2, and this is just it's a great summer beer.
Awesome. I'm going straight out of Portland, mainly because I thought it was straight out of Compton, the rap song.
Of course you did.
Right? Because that's what I do, right?
I mean, Portland and Compton, they're so similar.
Yeah, it's a 7.3 alcohol by volume, so a higher alcohol. But yeah, it's funny. My kids always they make fun of me because we'll be in my car and I'll go for everything from like old school Dr. Dre, Snoop Dogg, and like the very next song is like Carrie Underwood, and then the very next song after that is like Beck. They're like, "How do you listen to this?" I'm like, "This is just what I do."
It's who Ryan is.
Anyways, let's dive into it today. So Alex, let's break down what the issue is where and where this exchange fund comes into play. And this has been really up more and more coming our way with different prospective clients, and that is they used to work for a tech company, right?
Or still do.
And they're getting stock options, RSUs, right? Different stocks. And as those stocks are growing, more of their portfolio is now tied into one particular company, and they're recognizing, man, if this company has a bad year at the wrong time, it might hurt, and I'm not sure I can deal with that.
Yeah, we're talking, typical Silicon Forest type companies, Amazon, Microsoft. We've got a decent sized Google presence up here, but it doesn't have to be those companies. It's anybody who has an outsized position in their own company. I remember a client, my first year in the business. It was a colleague's client who they had a massive position in Warehouser and they loved their company. And it's totally fine. But when we actually shared with them, hey, do you realize that for every dollar that Warehouser moves, like your net worth changes like $100,000? They were like, oh, we don't love it that much.
Yep.
We don't want our wealth to be tied to it that much. Like we'll see this a lot with like Boeing folks, where it's like it's the company that built their lifestyle, which is awesome. But at the same time, we may not want to have all of our lifestyle tied up in that one company.
And so when you break this down, another aspect of this is taxation, right? A lot of times by the time people are getting to us, the taxes that they will pay if they're trying to diversify out of that stock and maybe purchase another stock, there's huge tax ramifications that they're not ready for / can do in the most efficient manner. I think a lot of people think of tax loss harvesting when it comes to this. And when most of your wealth is in one particular company and you don't have a lot of money elsewhere, the tax loss harvesting may not work out as efficiently as it could if you had another portfolio that you could offset some of the gains.
Well, and if we've had these stocks for forever, we've got an extremely low basis, or if they were granted to us or, given to us through stock awards or things of that nature, we may not have any basis in it at all. And so now anytime we sell out of it, it creates this massive gain. And so we needed to make sure that we're talking about like, okay, how do we mitigate that? How do we deal with that over time? And there are a boatload of different options. Today, we're talking about one of them. Actually, a couple of them, which is exchange traded funds or exchange funds.
So Alex just kind of messed up there too, right? The exchange traded funds. Like I think so often when when people reach out to us, they actually use the words exchange traded funds, but that's not what they're meaning. They're meaning exchange funds. So let's dive into the definition of an exchange fund here, Alex.
Sure. So an exchange fund, it's an option where you contribute your shares into a pooled asset. Other people are contributing their shares as well, and the idea is that if we wind up with someone from Microsoft, someone from Amazon, someone from Apple, someone from Google, we're going to wind up a lot more diversified. And if we do that 1,000 times, we'll wind up with a different basket of goods, and so it won't all be Microsoft or the Mag 7 or whatever else, and so we'll wind up with this diversified portfolio. And so now, as opposed to owning just one share or one company, we own a bunch of different companies. There are some downsides. Like you can't, this is not liquid for 7 years. That's one of the big
Often
downsides.
7 years, right? Like you need to look at the details of exchange funds, but as we've seen a lot of them, as Alex said, a lot of them are 7 years. The other issue, Alex, is you don't know what are the other funds or the other stocks that are being put into this fund. Like you mentioned four tech stocks right off the top of your head there. If that's the fund you're getting involved in, okay, is that really the diversification you're wanting?
Well, I mean, we talked to one of the companies that put this together, and they gave us an example of a restaurant where it's like they wound up, the guy wound up going into an exchange fund and wound up coming out the back end of it with a whole bunch of other restaurants, and like his response was, "That's I wanted diversification, not a basket of restaurants."
Right.
Um, so like that, there's tech is one example, but there's examples of this all over the place.
So an exchange fund can make sense. I know we listed some negatives, right? Those are negatives to be aware of. It doesn't mean to not do it because again, it really depends on what your balance sheet looks like. But what we want to transition to next is just kind of a sample client, right? Where they've got call it 1.5 million of stock in one particular company, XYZ company, right? And so the question is what do they do with the 1.5 million of stock? And so we want to go through like an example of what you could do over a period of time to help that diversification for the purposes of again you thinking differently about your money and not looking at it as an all or one stop product shop, if you will, like an exchange fund could be for you. And it might make sense to do that again. It's just more of again, let's look at the strategy piece. So Alex, we've got 1.5 million of stock. Why don't we start diving into it here?
Sure. So the first thing that we'd want to do is figure out, okay, how can we go ahead and create some amount of protection against that one stock? And so the idea would be that we're going to sell out of a portion of this position over time, and that's going to be dependent upon tax brackets and what state you live in, and a bunch of other factors. Like Washington State, where we live, just recently passed a new cap gains tax of 7% on anything over $250,000 worth of gain. So if we've got $500,000 that we want to liquidate and we have zero basis in this $1.5 million of stock, we'd want to make sure that we're liquidating that over at least a 2-year time period. And depending upon what the rest of their tax situation looks like, make sure you have a conversation with your tax advisor prior to doing anything.
Well, you should be working with the tax advisor and your financial advisor. Like they should be a coordinated group
Yes, they
working
should
with
work
you.
together.
They should not be working in silos.
Correct. And the more that you can have those people working in concert and crafting the plan together, the better off you are. And let's say that we wind up deciding that we're going to sell out of that position over a 4-year time period. Okay, well, if that's the case, how do we protect against downturns of our underlying stock, XYZ Co., over that time period? One answer is a colored option strategy, where what we're doing is we're buying the ability to sell at a specific down price, 5%, 10%, something of that nature. And we're writing the ability for somebody else to buy it at a 10% increase. And so, what this winds up doing is we wind up getting, some money for being able to, for we're limiting the upside for ourselves, because anything above, say, 10% or whatever number we choose, somebody else is going to enjoy that upside of XYZ company. And so we wind up receiving money to do that. And we then use those funds to buy a put strategy. So the upside is that horizontal line on the right side. Brian, if you'd use the mouse, that didn't.
Bear with me. Yep, that didn't work. Better?
Yep. So the horizontal line on the right side of our graph, this is where we're now limiting our upside in this example at about 20%, so that any gain on XYZ company winds up going to somebody else. And we're using those profits to go ahead and limit our downside in this example at about 10% on the left-hand side. That's the horizontal line there. So what that's doing is it's saying we're going to participate in the downside down to about negative 10%. Everything else is going to be protected by this put strategy. And everything on the upside, we're going to enjoy up to about 20%. And then everything else, we're going to wind up giving away to limit our downside. And so this winds up, there's ways we can go ahead and make sure that we don't have call away provisions and things of that nature, so we don't wind up digging ourselves a hole in the tax provision. The green line that Ryan just highlighted there is in that band from roughly negative 10 to positive 20. We are, whatever XYZ company does, that's our profit. But this protects us on the downside. It does put a cap or limits it on the upside. But if what we're trying to do is liquidate this, most of the time clients are relatively okay with that. And then we can periodically reset and manage this over time so that we can, as XYZ, ideally, XYZ goes up in a range bound manner, and we wind up having the strategy pay for itself. And in that example, then what we wind up doing is 6 months, a year down the road, we reset these limits so that we're resetting the floor higher and resetting the ceiling higher. And so if we wind up going up in a range bound manner, it's a way for us to enjoy profits on the upside without having the downside risk. So this is called a covered or a collared option strategy, where essentially what we're doing is we're giving up upside to protect ourselves on the downside. And we want to do this with whatever we're planning on intentionally liquidating over whatever our time period is, 3 years, 5 years, whatever the time period is. But these are funds that we effectively want to try and have as liquid as possible. And so in a worst case scenario, we're down 10%.
So that's one strategy that you can utilize. That's not the exchange fund that you could do. So Alex, what's another strategy that they can utilize?
Sure. The second strategy is an exchange replication. And what this is designed to do is it's designed to replicate the exchange fund, but still maintain liquidity, so we don't wind up with the 7-year mandatory hold. And so what this does, it also uses options. So we've got the same collar strategy going on. But in addition to that, we then put in kind of the opposite version of that, where what we're using is we're using options to go ahead and expose ourselves to whatever market index we want, whether that's a mix of indexes, whether that's the S&P 500, QQQ. There's ways that we can go ahead and effectively buy options. And if we're structuring it in the same way, we can buy options so that there's minimal cost to be able to go ahead and effectively have a line up where we're trading off the risk of XYZ company for the underlying risk of whatever index or whatever market tool we're trying to create.
So we've gone through 3 different strategies, right? The pure exchange fund, the collared strategies, and then the exchange fund replication, essentially, as Alex just explained it, right? Those are 3 different strategies. that you can employ. And again, it doesn't have to be like, if you have 1.5 million, maybe you do 500 in each.
Right.
So again, this is where strategies come into play. And I think too often when at least when we're speaking with people, a lot of times they're only looking at like a one size fits all, meaning like all in the exchange fund or all in the collared strategy, right? Not looking at like, okay, how do we make this as efficient as possible while having liquidity for life events, both good and bad, maximizing returns, limiting the risk of the portfolio, and putting this into a strategy of eventually turning on the income stream. That is overlooked all of the time because we've said this 1,000 times. The whole reason we are saving money and have these stocks is so that we can have a income in the future.
Yeah.
So if we're not, we got to think with that in mind. So we wanted to go over this because, again, we keep getting questions around exchange funds. So we wanted to get this information out there. Alex, any other 2 cents that you wanted before we close up here?
Anybody with a concentrated stock position, and we would suggest that a concentrated stock position is anything where you've got more than $500,000 in an individual stock, and it winds up being more than, say, about 20% of your overall portfolio. Sit down with someone who is well versed in doing this type of planning. Make sure that you're including your tax advisor and create a strategy and a plan for whatever you're going to go ahead and accomplish. If you don't have that, reach out to us and see if it makes sense to work with us.
Yeah, so make sure you head over to beerandmoney.net. At the top of the page there's a contact us if you have any questions, as well as this, for those of you listening in your car, right? The visual that we just had might be important for you to look at that visual. So we do have a YouTube channel. You can go to the beerandmoney.net site, and on the site itself, on the episode page, we'll have the video of that. So make sure you take a look at that. And last but definitely not least, we had quite a few people reaching out to us where they're just kind of looking for like a general overall like scorecard of how they currently look financially. And so what we've done is in the show notes, there's a link for you to go in and get your own scorecard. And just so we're being clear here, this is in the tool, the Living Balance Sheet tool that we utilize for our clients, but we do not get any of this information unless you click the button to send it our way because you're wanting us to look at it. So this is private for you to do this exercise, so you can take a look at what you look like financially. We started this podcast to help you think differently about your money so that you can focus on spending time with your family, right? Not having the stress of the finances in this conversation. So, as always, we hope this episode was valuable for you. And Mr. Collins,
looking forward to summer. Cheers.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7624835.1. Expiration date February 2027.